Guys, Enphase on September 15th was at $120 a share. It keeps falling. It's at $97 a share off its all-time high of $340. Guys, it surprised us to the point where we added it to our watch list. So guys, let's check out Enphase right now, go through the process to see what interested us about this company. Mo, what you got on good old Enphase?
Well, solar company, a lot of volatility lately. This is the company, if you don't remember, on October 20th, it was still around 120 and it just started to free fall. Do you remember that? And then the earnings report happened and it fell even more. Now it's rebounded a little bit. It's just all over the place.
Yeah, and back in November of 2022, December 5th of last year, so about a year ago, hit its all-time high of $339 per share, $340 per share. I just remember seeing this thing. When we were day trading or trading, we'd see this thing every single time.
Every time.
It would be up 10, 15, 20% down. It was incredibly volatile business. Market cap of $13 billion, revenue of $2.7 billion. Now, so here's some positives here, Mo. You look at this.
All right.
Net income, $571 million. Free cash flow, $844 million.
That's good.
So if you guys are new to this, we love the fact that free cash flow is higher than net income. 5-year average net income, $250. 5-year free cash flow average, $385. So again, a higher free cash flow than net income. A lot of times companies will try to manipulate the numbers to make their net income higher than their free cash flow.
Mm-hmm.
I prefer it this way around, okay? No dividend, of course. Price to free cash flow currently of 16, 5-year average of 35. So a lot of growth here.
Mm-hmm.
A lot of growth. You say that with a lot of confidence.
Pretty good ROIC too.
Oh, wow. 25% and growing.
I'm shocked.
Good gross margin too.
These guys are a big player in the world of solar.
Oh man, look at this growth, Mo. This is 2014, 305 million.
Wow.
To 2.7. But look at this, Mo. 2014 to 18, no growth.
Wow.
Essentially flat. Look at that.
It must have been pre-disruption.
And then skyrocket city.
Yeah.
And I think solar is going to be here for a while. And it's going to get more and more cost effective. Have you ever had solar quoted for you, Mo?
Yeah.
Where?
Florida.
On your new house in Florida, your parents?
Yeah, my new house.
What did it come in at?
45,000 maybe.
And what would have saved you?
I don't remember. I did this in August. It's been a while.
Yeah.
I can pull it up.
So, we have those homes in Mexico, and in Mexico, it's a little bit different. In our city in Mexico, we have our houses. Mo's a part owner. They charge utilities based on the value of your home. So like if you're in a more expensive neighborhood, you pay more for utilities. The electric costs down there are 4 or 5 times more per kilowatt hour than up here. So we have immense savings down there. If you spend $50 grand one time on solar panels for one of our houses, and they have 350 days of sunlight, you can potentially save yourself $10,000 or $15,000 a year, which is a great ROI. But here in the States, it's a little bit different, especially in a state like Ohio, where we only have about half the days with full sunlight. You end up getting, I remember back when I was first pitched solar back in 2008, maybe 2009, the returns were literally 1 or 2%. I just sat there and said, listen, I get it. I get the idea here. But at some point, it's got to become more cost effective.
So here's the estimation if it were to happen. Old utility bill or current utility bill, $400 a month. Estimated new bill, $53. And it would cost
53, you mean 25?
25.
Where'd you get 53 from?
It's 53,000 to put it on.
Oh, okay.
It was 53,000 to put it on.
All right, so 375 savings times 12 is 4,500 a year, 53,000. You're getting about an 8%, 9% return.
Yeah.
Not something to sneeze at, but not anything that I'm like, gotta do it.
Yeah, it wasn't like I have to do this.
Right. But hey, listen, like I said, it's a good look at cost of goods sold, good gross profit. I mean, I look at this thing, okay, and they've been profitable ever since 2018 when they hit their low in revenue. They've been skyrocketing since.
So I have a couple notes here.
Well, go ahead.
Total revenue declined 13% in the most recent quarter.
Oh, wow.
Net income fell about 7.5%. R&D expenses increased 24% in the quarter.
Okay, that's good.
Yeah.
You want to see something else?
Yeah.
Shares outstanding 10 years ago.
Wait a second.
48 million.
148 million.
144 million now.
Wow.
Guys, they're diluting. Now, big jumps.
When did the big jumps occur?
I mean,
every year.
These 3-4 years in a row had big jumps. So were there acquisitions? You got to look at those things, guys. Remember, we don't like big jump in the shares outstanding because it's diluting owners in the business. The shares are up
There were no acquisitions.
3 times, right? So the shares are up 3 times and the business is 9 times better. You're not seeing 9 times growth. You're seeing 3 times growth. So it's still good, but remember, dilution is not a good thing for those of you out there who are running alongside the company. You're saying, hey, listen, we believe in you. We're going to invest with you. And the company is thanking you by diluting you as an owner. I don't understand how that really works as a good thing. But again, you have to ask the question, why are you giving away shares if you're growing so much?
Mm-hmm.
To me, it's like take on the debt. I know the debt isn't a good thing, but let's see how their balance sheet looks. Because they're still a fast growing company.
Yeah.
Total current assets, $2.6 billion. Total liabilities. Oh, wow. They have plenty of cash on hand. They can pay off all their so that's a good balance sheet.
Interesting company.
Why you say that?
It just is. Because in my mind, I think of it as one of those like hype companies that is going to do all the wrong things, like a Peloton. Because that's kind of in the world. Like when we were trading all the time live, Enphase always came across
every
the
single
screen.
time.
And that's why to me, I look at it and go, wow, there are some good things here.
Then look at these 8 pillars right here, Mo. So obviously the X on shares outstanding.
They're not
and
bad
then
though.
Price to free cash flow. I actually am surprised by how many check marks there are.
It's really not as bad as I assumed, especially the ROIC.
Yeah, let's see what analysts are saying about this bad boy.
Really good growth.
Really good growth in the EPS from 514 a year this year to 947.
Good
Revenue growth, really good.
Yeah.
2.7, doubling essentially in the next 4 years.
Mm-hmm.
So I don't remember when we did Enphase before.
Neither do I.
Let's see how their cash flow is too. Guys, it's really important, especially with companies like this. And, my initial thought is, all right, a growing industry, a lot of hype behind it. You have a company that's diluting their shareholders. Oh, that's a tough one for me. Just that's actually what's bothering me the most. Because I think you can get around the valuation with the growth story there.
Yeah.
But then you sit there and say, okay, but if they keep diluting their owners, what's going on there? I want to look up this income statement you said with the drop.
I mean, if you actually look at the last 3 quarters, they've been buying back shares.
Oh, good for them.
So,
there was a drop. You're right, Mo, from 634 million in September quarter of last year to 551. That's a big
huge drop.
They made the same amount of money, $114 million. So a drop in revenue by 15%, you said?
Mm-hmm.
Yeah, 15%, and still the same profit. Wow.
13%. Yeah.
Some of the things that helped them, other income and expenses. So negative 3.2 million in other income and expenses to a positive 19.36. That's a $22 million swing. And then net interest income, 1.43 to 20 million. Why? Interest rates went higher. Yeah. Companies are getting a lot more interest income on the cash in their balance sheet. And this company has a lot of cash on its balance sheet. A lot of cash.
Mm-hmm.
So let's run our stock analyzer tool. Now, I'm looking at this saying, guys, I'm going to assume we're not going to alter the number of shares outstanding in the stock analyzer tool, but you've got to keep that in the back of your head. I think, in my opinion, you have to increase your desired return. It's basically your margin of safety here at the end because of this increase in the number of shares outstanding. Guys, real quick, you like the software, you like the community. The community is awesome. A lot of people in our community talking about this. Check out our free trial, everythingmoney.com, 7-day full access free trial to get the community and all the software and all the tools that are right up here. So, Mo, did you actually do it in Stock Analyzer back in September?
Yeah, I did. I did it. No, I actually did it in November 27th.
Oh, as in today.
Oh, wrong. That's funny.
I did it September 11th. Never forget.
Never forget.
Okay. I'm pulling it back up again.
That's funny.
Mo, what'd you do for revenue growth for 10 years?
So I did 10, 15, and 20.
Okay, I did 10, 20, and 30.
Okay.
Profit margin.
20, 25, 30.
I did 15, 20, and 25.
All right.
Free cash flow margin.
I did 20, 25, and 30.
I did 25, 30, and 35. I mean, I don't know if that's...
I honestly don't know if you're too low or I'm too high. I don't know. I'm kind of just... I feel as though they are a very dominant player in this market. That's why I'm giving them these.
I'm actually going to change my revenue growth.
Okay.
I mentioned my revenue growth to 8, 14, and 20%.
Okay.
Because I think to myself, even 14% revenue growth is a lot of revenue growth for 10 years. I'm going to assume their profit margin, because they have a decent gross margin, 45%.
Yeah.
Free cash flow is good. Okay. So what'd you do for PE and price of free cash flow?
I did 17, 20, and 23 for both of them.
So I did 15, 18, and 25. I went high here. Now, I think we were there was a specific reason why we did that. I'm actually going to change my PE to 13, 16, and 19. And then what's your desired return? I'm also going to change mine. I did 15, 20, and 25.
So I did 18, 21, and 24.
I'm actually going to do 14, 17, and 20. No, I'm going to do 14, 18, and 22. Now, guys, I want you to see, like, we're sitting here. I look at Enphase going, why do I want to own Enphase? I want to own Enphase if I'm going to have absurd returns. You know what I mean? Like, I'm really, really changed my method of investing to focus on really large companies, established businesses that have some slight mispricings. It's not important to me to beat the market by a huge number. What's important to me is get the returns that make sense to me, owning the assets I want to make, owning the assets I want to own, and the returns, if I can beat the market, awesome. Yeah. So I hit the analyze button. Mo? Okay, this is interesting.
Yeah.
So I got a low of 41 to 68. Now remember, the reason for the big difference is because of the big difference in our net profit margin versus free cash flow margin. I have a high of 115 to 160 and a middle price of 71 to 107. So it's green in two of our areas. But again, I don't know if I want to own this company. Like, if I'm going to put this on, you know what I should do? I'm going to add it to my watch list at 70. Because I'm not like, if it went from this to 500, I'm not going to lose sleep. I'm like, okay, I missed out on it. But if it falls to 70, I'm going to be like, okay, let me go just deeper dig, see how Enphase is. What numbers did you get?
At 56 on the low end. I remember my earnings and cash flow were the same. 137 on the high, about 90 in the middle. But with these returns. So if you can expect that they're going to do 20% revenue growth for the next decade with these types of margins, then yeah, you're gonna crush it if you buy it right
You
now.
are absolutely going to crush it.
But that's questionable.
Well, that's the thing. But you're right though, Mo. You put some big numbers in there, including desired return of 24%. So if you pay today's price and your top assumptions occur, you're going to make 29% returns per year for the next 10 years.
Yep, you can do very well.
Guys, everythingmoney.com, 7 days, free trial. Go check it out.